Good morning and welcome to the weekly mortgage market update with Kevin Peranio. Please let me introduce the president of CAMP, Ms. Audrey Boisno. Audrey?
Thank you, Megan. Good morning, everybody. It's good to see you. I'm glad we all made it through this crazy weekend because just when you think it couldn't get more strange and bizarre, here we are. So welcome this morning. I want to say thank you to Kevin Casey, our president-elect, and Megan Jackson, who helped us put everything together on the back end of these webinars and all the events that we're putting on. And without her, we would be completely hopeless and helpless and probably not happening. So I would also like to let you know what's coming up next. So tomorrow at 11 a.m., we are extremely excited to be putting on a credit and COVID webinar with Terry Clemens and John Arcari with FICO and National Credit Reporting Association. And they are going to enlighten us as to what they're seeing with regards to credit, COVID, and at the bureau level, at the ground level, at the policy making level. It's going to be really, really interesting. So I'm very much looking forward to that. Thursday, we are going to do, and that will be at 11 o'clock tomorrow. So Thursday, we will be doing a camp social happy hour mastermind brainstorming session. We started off with, we're just going to do a happy hour last time, and it really turned into a meeting of the minds, and it drove home the point that people are sitting in their offices by themselves, and they need to be able to talk to other people and have a way to run their scenarios and figure out what everyone else is doing and what do you know that I don't know and what can I use, etc. So that is what Thursday is going to be. So look for the notices that are going out on those. It's posted on social media. And also know that we now have an Instagram page and a Twitter account. So we are totally getting with the program here. So please follow us on Instagram, on Twitter. We're on LinkedIn. We're on Facebook. We are all over the place and upping our game all the time. So please follow. Next week, we'll be doing our Tuesday update with Rob Chrisman, who is always a wealth of information, and we love having him on here. He's such an asset to the industry. So during today's session, as we are working with new people on these Tuesday updates, we invite you to ask questions as always, and we can have a discussion about whatever you want to have a discussion about. And also make sure that you're looking for calls to action, et cetera, because there's a lot going on in the industry. And as always, please be a member. I want to say thank you to today's guests. They are a statewide member, and as CAMP is a nonprofit and run mostly by volunteers organization, it is critically important that you're a member, that your friends are members, that your Aunt Martha, if you could talk her into it, is a member. Okay, maybe not her, but with any, in any case, just please be a member, and thank you to our statewide members like PRMG. So with that, I would like to introduce today's guest, Kevin Peranio, who is the head of PRMG. They have a wholesale and a retail division and are very active in the industry. And he has been very much up on what is going on out there on so many different levels. So Kevin, thank you so much for joining us today.
Thank you for having me. I really appreciate it. I love serving this organization and the state, my new home as of 4 years ago. And to be fair, there are two gentlemen, Paul and Robert, who founded PRMG 19 years ago. And I was fortunate enough to link up with them almost 10 years ago now, and they brought me here to be their partner 4 years ago. So I've had a chance to be on the front lines, be a wholesale AE, originate, run ops, run sales, and now run my second company. And it's been fascinating to just go through this crazy last 90 to 120 days, even having experience in 08. It's been amazing, but I think better times are ahead for sure.
I certainly have been grateful for my experience in 08. Whoever thought that would be how I'd feel, but going through this made me understand how valuable that little war was. And I feel for the people who haven't been through that before, just because this is all new. And we have to keep reminding ourselves and each other that we are going to come out on the other side of this, and already are to some extent. And everything's going to be okay. It always is, right? We're in the mortgage business. We adapt. That's what we do, and it's a beautiful thing.
I agree. This too shall pass. Those are the words I use quite often.
Absolutely. So let's start with let's just start with just reminding people, send in your questions. So let's talk about this last week. So I am curious as we are going into June. So there are a lot of changes that were supposed to happen in June, right? We were supposed to be opening up economies. The states seem to be opening. And now many of us are completely boarded up. I am coming to you from my office, which is literally boarded up. I can't even explain how we got in. It was insane this morning. So, but our buildings are boarded up. I'm in downtown Walnut Creek. We've had riots. We've had protests, and the protests aren't the problem. It's the looters and the rioters that are the problem. And so all the businesses that were opening back up or who had been struggling for the past 3 months are now boarded up. So can we talk about what that impact will be if you have any insight into that?
Well, I think the greater impact is not because of the civil unrest. So, I'm very positive, and I could be wrong in what I'm saying, but I feel like, it's been 8 days since George Floyd, was slaughtered, and that really, set off, quite the reaction. Obviously, there's been racial injustice in this country for years, but we don't need to go down that path. I want to try and keep it more business, but look, as it relates to business, many people are not working, especially the uneducated, the poor. People who were earning $30,000 a year or under make up 73% of all the jobs that were lost in the 40.7 million jobless claims. The continuing unemployment claims is 25 million, so that's actually improved. So the headline number for weekly jobless claims and benefits is the big number, but as of a couple weeks ago, we've been watching data trends of people going back to work or back to school or working part-time. And so the continuing unemployment number has stayed under 25 million. And that's a good sign. So people are going back to work. But I hate to say this, but as it relates to the housing industry, overwhelmingly the people affected are not homeowners. Now, where it does impact homeowners and refinances and potential new buyers are those who are self-employed. And small businesses still make up about 55 to 60% of all the job creation in America. That's businesses under 500 people. These PPP programs, they're still under effect. So there's still some payroll programs that are helping those, but the actual business owners who are not generating revenue, it is up in the air where that's going to land. I've heard as many as 40% of all jobs are not going to open back up permanently. I've seen a stat that says about 50% of the small businesses will permanently close within 6 months. So, that is going to have an impact for sure. We're going to have a smaller economy. That is what a recession is about. We are not going to go back to where it was in January, February. So I don't know exactly where we're going to land. I got to think that the civil unrest and the protesters, the brother of George Floyd came out and said, look, this is not how we honor my brother.
And his son.
Yeah, and his son, and Michael Jordan, and LeBron James, and people that we all look up to. And so, I have a feeling that with the forceful reaction on a Monday, the first business day of the week, I saw a tremendously different reaction than the weekend. I saw the weekend was like, all right, everyone get your feelings out. That's cool. You can go break down some buildings. Just don't kill anybody. No shots fired. It's all good. But yesterday was different. Yesterday here in Costa Mesa, which is a bordering town on Newport Beach, I have my own, little experience. We've had a curfew for 2 nights. My office is in Corona and Riverside County. There were protests and looting yesterday even, and over the weekend in downtown Riverside and San Bernardino. But the cops' reaction yesterday was different. It was like, okay, we're going to jail. Come here. Like, we're not taking this anymore. Enough is enough. You're destroying small businesses. You're hurting people's livelihood. This is over. That was Sunday. This is Monday. And so I have to think that the risk to business, the peak of the risk to business was Sunday. And that's why I did my LinkedIn video Sunday night saying, I feel like the worst is past. That doesn't mean that there isn't going to still be some destruction or some fires or some civil unrest, but the reaction is forceful. I mean, gosh, our president was tear gassing people right outside the White House so he could, go across the street, for his, scheduled, photo op. And so I'm not here to comment on that. I'm here to just say the reaction is like, it's over, like, okay, we're not doing it like this. And so I still think the greater impact on business is the prior 90 days, is the fact that, we don't know what 25%, 20 to 25% unemployment is going to be. We get a big headline number on Friday, and that number is for basically the second half of April and the first half of May. So they say it's May unemployment, but it's really like half to half because they need time to compile the statistics at the Bureau of Labor and Statistics. That number should be higher. It should be in that probably no worse than 25% unemployment. And a lot of people think that's the peak. And so, so I think, yeah, and thank you. And so how does it relate to us? I mean, how does it relate to our business? How does it relate to you being, go into an office that's not boarded up and do your thing?
Right.
It's just more argument for a new economy. Work from home economy is here to stay. It's not going away. Businesses are looking at, why do I need to spend money on an office building? Why do I need to have a physical location? Look at the companies that are doing well in the stock market. You see the stock market soaring, and you're like, how is that happening when people are suffering, emotionally and financially? And it's because businesses change right in front of our face. Did you know that before this COVID-19 lockdown, about 10% of commerce was done on e-commerce, and in 2 months, it was 30% in the United States. 30%. I mean, that's a massive jump. And so, it just, everything is changing right before our eyes. Everything has accelerated, and it really bodes well for our industry. We can work remote. We can focus and find and use data to find deals that are good. I mean, if we're at 25% unemployment, we're at 75% employment. And so some of that may be self-employed, so maybe they don't qualify. I mean, you and I were just talking about some of the big banks and how they're being really tough on jumbo loans, especially on self-employed borrowers or cash out. I mean, people are these banks, they're trying to be careful with their cash right now because they don't know the absolute results of all of this. And so, but again, this too shall pass. In a year, it'll be a different story. Non-QM is already starting to come back. I see cash out hits going away on rate sheets. I see FICO minimums decreasing. I see things getting better. And even though this weekend, it looks like, our world was on fire, literally.
I've been a big.
So that was one of my questions was, as far as guideline changes and how those are going to roll back and the timing, et cetera. So again, we're starting to see it now. What will it take to go back to, say, a normal BOE process at the end of a loan right before you close? Is it going to be months? Is it going to be a year? How long do you think it will take to get back to where we were? Any ideas?
There's two really big things that need to happen for mortgage bankers and banks to feel comfortable about this. It all has to do with the forbearance policy. So HUD, to this date, HUD has not come out and said so we do something. Most lenders of any size are able to self-insure their own loan. We don't have to send the loan to HUD for them to underwrite and tell us it's good. We just insure it because we have the financial strength and experience to do so. We've had that for well over a decade. So for us, when we self-insure a loan and then we sell it into a Ginnie Mae pool, we service it, or even if we sell it to an investor, let's say that some of the aggregators are starting to come back in. They want to pay now. They think the value of the mortgage servicing right, the MSR, is back, right? So let's say I want to sell it to AmeriHome or PennyMac or Wells or Chase. They have to feel good about buying a loan from us, or anyone for that matter, that is going into forbearance. And so HUD loans are at about 12% forbearance. So that means borrowers have requested to be put in forbearance. That doesn't mean they're not paying, because we're seeing a pretty sizable minority of that 12% are still making their payment even though they requested. So the first.
Do you have numbers on that, Kevin?
I do.
Do you know
I do.
Okay,
So
great.
let me answer your question, your first question, and then we'll do that next one. So there's two big things. If I do a loan, if an FHA, VA, USDA loan, and it's insured, and that borrower goes into forbearance, I want to know that that insurance is still good with HUD. I want to know that that FHA loan is still good. So am I going to sell that loan to someone and then the borrower for whatever reason just ask for forbearance even if they're making their payment? They simply ask as just like, hey, well, it's 12 months payments, no big deal. Am I going to get a repurchase as a lender? So for me, I need to know that. And the second big thing is they need to close the forbearance window. I mean, right now, there's no end in sight. When do borrowers no longer have the right to ask for forbearance? So my guess is the next congressional act, which you can see Congress is kicking the can down the road. They don't want to spend another $3 trillion or two or four. We're broke. We're broke as a country. Deflation and depression are the worries, not inflation right now. And I'll get into that in a little bit. But my point is, we need to close a forbearance window for anyone that services a loan, whether it's us, which we're servicing almost 100% of our loans, Fannie, Freddie, and Ginnie. We need to know we need certainty on what happens with that asset if a borrower goes into forbearance, or that they can no longer go into forbearance because we still have to front money for that when they don't pay. So those are the big hurdles that everyone's looking for. So I hope that answers your first question.
You had mentioned 12% for HUD. What is it for FHFA if you have those numbers? And then we had heard some shocking numbers on the subprime front. But again, when they're asking for forbearance, or also when they're put into forbearance by their bank without them even realizing they're in forbearance, that's the other issue, versus not making their payments. I'm interested in the actual not making their payments numbers versus the forbearance request numbers.
So
on
we
both,
find, yeah,
in different segments.
Yeah, so if a borrower takes the actionable step to call in and ask questions about forbearance and then request to be put in forbearance, remember the servicer cannot ask for documentation. They can merely say as
Right.
part of this, are you suffering a hardship because of COVID-19? And if they say yes, that's it. The servicer is probably going to go, okay, boom, you're in forbearance. I have heard anecdotally that there are borrowers that say they didn't ask for it, but were put into it anyway, but then made their payment. Well, then so what? I mean, it doesn't affect your credit score. It's a footnote under that trade line, and it will say forbearance, or there'll be a note in there, but it isn't actually reported as a late payment, especially if they make the payment.
But it does impact their DU approval, which you had an instance of that a few weeks ago. So what if they were put into forbearance and now they're trying to refinance, and DU kicks them because it says they're, whatever the coding is, even if it hasn't impacted their credit scores, it's impacting their ability to do a transaction. So how are you dealing with that?
So you have the ability to do a rapid rescore. So
right, is that what you're doing or requesting?
Well, let me say this. I mean, if the borrower has missed a payment, then like they're not eligible for a loan. Like if we see
right.
if we see a credit report, it's got a footnote and they've actually missed a payment, we say come back when
right.
you either reinstate the loan, and if you can't do the lump sum, which is what they call reinstatement, if you can't do the lump sum
Yep.
payment and get caught up, then you can go into any one of the loss mitigations, which then you need 3 consecutive months of payments. Now, if I get a credit report where the footnote says forbearance on the trade line, but they have been making the payment, then they can go back to their servicer and they can say, hey, get me out of this thing. I've been making my payments. I'm not in forbearance. So they can ask that way, or we can try and facilitate a rapid rescore as long as they show proof of payment. And then rerun, hopefully the credit report. Obviously, that has problems too, running DU with the rapid rescore. So anyway, that is how we're handling that specific instance. Now, as far as the data inside our portfolio, this is just our portfolio. So the first month after April, we saw about 40% of our borrowers that were in forbearance still made the payment. Okay. So now our when we came into this, we had about 6,500 units in a portfolio coming into the whole crisis. About I'd say probably somewhere about 800 to 900 borrowers in that book have asked to be in forbearance, but really only about 550 of them did not pay, and that's almost all Ginnie Mae borrowers. So we're right at about 12% on our book
Okay.
of just of the original 6,500 borrowers. We're right at about 12% of borrowers that are in forbearance. But then, like I said, many of them make the payment anyway. So for us, we feel this is no different than when we dealt with hurricanes in Florida and Texas and had forbearance back then. So we're experienced at this. We've been servicing. This isn't new to us. We didn't decide to just start servicing now because all the aggregators didn't want to pay. I see some lenders out there advertising like, hey, we're servicing 100%. Yeah, you are, because no one's paying you for the asset. You had to. So,
Right.
they're gonna have all the problems dealing with servicing. We've been here and done that. So now what I will say is on FHFA loans, which governs Fannie and Freddie, we have tremendously less forbearance requests, and then even less actual non-payment. Mark Calabria, the director of the FHFA, he has live data. He could literally pull up a screen and look at any second the loans between Fannie and Freddie that are in forbearance. And when he puts out his numbers, he's still at about 6.5% for Fannie Freddie loans that are in forbearance. I've seen reports. I saw a Forbes article. It feels like 2 weeks ago now or 10 days ago, but maybe it was last week. Who knows? I saw a Forbes article that reported as much as 70% of borrowers in forbearance are making their payments or have said, yeah, we can make our payments. We just took it just in case. So I think the reaction was erring. Whenever there's uncertainty, we're erring on the side of caution. Servicers erred on the side of caution. Aggregators, banks, non-banks alike. Everybody. And so
Right.
all the voices out there trying to hammer FHFA. I got caught up in that a little bit. But it's still very expensive. And it still costs a lot of money to front for these borrowers that don't make their payments. I think when Mark Calabria said, hey, you know what, servicers, you make the first 4 payments for Fannie and Freddie loans, we'll make payments 5 through 12. That was huge. That brought certainty. Okay, you know what?
Right.
We're gonna buy loans in forbearance even after they funded. Okay, but we'll charge you 700 basis points for a refi, 500 basis points for a first-time homebuyer. You know what? Out of all the new loans, we put about 6,000 to 7,000 new loans in our portfolio since it started. New ones, not the old legacy book at 6,500. We have less than 50 borrowers in the new book that have asked to be put in forbearance. So to us,
I see that.
We're like, we put out an extra addendum for all the borrowers. I remember one of my brokers sent us an email and said, I felt like this addendum was a feel good condition. I'm like, damn right, it feels good not to have to pay $1 billion a month for people who don't pay. We don't want to do loans to people who don't pay. It is a feel good proposition to do loans for borrowers that make their payment. Forbearance is not forgiveness. This isn't a free lunch. And so thank God our originators in all 3 channels have been overwhelmingly positive. They don't want this on them either. I mean, could you imagine being a non-del correspondent? You have a warehouse line, you're a very small up and coming lender, and you get stuck with 5 loans that your lender won't buy. You're likely out of business, to be honest with you. Like, you're out of business over 5 loans.
Exactly.
I mean, these lenders that do 20, 15, 50 million a month on a warehouse line that they get through, a warehouse center and sell to someone else that's doing the underwriting, they're not on the hook. And so we were in the same position if we turned around and sold to the aggregators. So we just made the decision, like, these guys aren't paying us for the asset, so we're just going to service all of our stuff anyway. So we sell into the cash window, and it's off our book, usually within a week. There's hardly enough time for the borrowers to even go into forbearance. And having said that, they aren't even doing it anyway. So we're feeling really good. The data is very positive. There's still uncertainty when the window for forbearance will close, and there's still some uncertainty with HUD, and we need that certainty to get FICOs back down to 550 manual underwriting for whoever needs it, to get all the down payment assistance programs for larger investors to feel like they can spend their money on jumbo loans, and non-QM loans, which we're starting to see both of those kind of thaw out as well.
Yeah.
Even in the high balance stuff, it's starting to thaw just a slimmer.
Yeah, high balance is a different animal. So, it is for California-based lenders and California-based originators. the 10% de minimis rule, and just for those that don't know, when anybody pools loans to Fannie or Freddie, only 10% of that pool can be a high balance in nature. Remember, I mean, Fannie, Freddie, and Ginnie, when they decided to create the high balance system and do that, they were stepping in, providing liquidity to the marketplace, but they did not want to become the jumbo lender. They were basically saying, look, we see that there's a problem here in the market, and in counties like you guys are up in the Bay Area, you guys, you can't. I mean, a high balance loan is like,
doesn't even work. Purchases.
Yeah, it's like a HELOC for most parts of the country, so.
It's a starter home. I mean, in a outlying area.
So lenders have to be very mindful. The difference, I mean, if they have 10.01% high balance loans in a pool that they sell off, the hit, I mean, I've seen hits from some investors. It's like 500 basis points. Oh, you've gone over your 10% maximum, your de minimis. We're going to charge you now an extra 5 points on every high balance loan you sell us. I mean, you can't model for that. We take your lock in 30 days ago, kind of modeling in and, making sure we're about 10% spread amongst whoever we sell to. And then the time comes, to lock and close and fund the loan and then sell the loan off. If we go higher, we undershot our modeling. Now we locked it with you and we're promising to pay you, the originator, something, but then, I turn around and sell it and they're like, here's a 500 hit or here's a 700 basis point hit. You can't do business that way. So people are being a little cautious with high balance as well, and that's the mechanics of what goes on behind the scenes of why people are cautious. And right now, every high balance borrower in the world, especially right now, they're saying money is the cheapest it's ever been. Now's the best time to do a refinance. So they're all coming out of the woodworks. So it's good to have options and make sure that you wherever you sell your loans to or however you originate high balance, that you have options for a home that can kind of balance that 10% de minimis.
We get a lot of questions about high balance pricing when we do these webinars, and we keep talking about the de minimis. And for a lot of people, that's been a new word to learn and understand how it works on the back end. So every time we can cover it like this, it's helpful, I think, because it just becomes a little more clear every time. And for those who are listening who hadn't understood that before, that explains our high balance pricing. Is they are trying to model to protect themselves for going over the 10%, which is easy to do in these areas and in a lot of the country. So I have started whispering about maybe we should be pushing FHFA and helping them understand that it would be perhaps helpful to change that de minimis. It's a number they chose however many years ago, and maybe it's time to expand it. Even if it was ever so slightly, anything would help in our areas. So something to take under advisement as we're advocating.
From
what do you think about trying to get them to change it, Kevin?
Yeah. Oh, we are all the time. I mean, all the agencies are constantly hitting up FHFA. But from what I've seen from Director Mark Calabria and his comments, they don't want to do HBA. They don't want to do any more.
No, absolutely. Yep.
Like, hey, that's, we're here to provide liquidity in the marketplace, but only so much. And remember, they're trying to raise capital. Let's say the number they came up with is fairly accurate, $250 billion. $250 billion in capital is what they have to raise. If they don't have to do high balance loans, they get to their capital requirements much quicker and they can go private much quicker, which is really their main goal over there. I mean, that's the absolute main goal and focus of Mark Calabria. He wants to turn it over to the private market. He wants Fannie and Freddie to be privatized. He is a libertarian. He came from the Cato Institute. He was tapped by Vice President Mike Pence. It is their free market, private market mission to get the taxpayer off the hook for what happened in 2008 and what's happening right now. They want nothing to do with it. They want to turn it over to the private market. And so actually expanding high balance hurts that mission. So, we can ask all, we're not getting that.
Right. So how different do you think that the last 3 months would have been if FHFA had been privatized already and wasn't backed by the government? How would that work? How would that have worked? If any, and if you don't know, it's fine, but I'm just curious what this would have looked like instead of what we had.
I think the overwhelming opinion is that if they were private in this market, it would not work. So it would not work. We need a lender of last resort, okay? Because what people do is they say, okay, you know, they turn around and look at the other private companies out there, like people who we sell loans to. If we didn't service loans, we would sell loans to private companies, or banks. Do you know what they valued servicing in March and April? Zero.
Right.
I mean, literally zero. Some of them, you had to pay them 50 basis points to take your loan because they said that mortgage servicing right was worth zero because they had capital requirement issues. And so I think it's easy to say it wouldn't have worked. Now, I will defend Mark Calabria here, because if there was $250 billion in cash sitting there and they were capitalized enough to withstand a swan event like this, a black swan event like this, or '08, maybe their actions would be different, and maybe it would be positive, and maybe they would be able to get us through something like this. So I don't think anyone can conclusively say it would not work. My opinion is I don't think it would work because, you know, I just feel that unless there's something written in their bylaws of how to act, I mean, who is the lender of last resort? I mean, the Fed is. So I guess basically if Fannie and Freddie were private, then like like Wells and Chase and Mr. Cooper and PRMG, if we needed capital or liquidity assistance, we would all be begging Fannie and Freddie. We would all be begging the Fed. And so what sucks about that is the Fed is taking influence from the Treasury, and the Secretary of the Treasury, Mnuchin, he comes from Goldman Sachs. He comes from the private world. They don't have any love for independent mortgage bankers just because we're in the community and we help out and we serve. They don't care. It's a pure balance sheet play. I mean, you see him talk, he's like a robot. I mean, it's like, do you have the balance sheet to withstand this? If you don't, you should not be in business. Period. End of story. And so I don't see the Fed bailing out companies that.
It'd be like the non-QM market.
It'd be like the non-QM market. It just dried up. I mean, unless you're an airline and you're deemed essential, or the auto industry and you're deemed essential. I mean, we're essential, but there's enough players to bail out. Like if Wells and Chase needed money, they could get bailed out, and then and they would stand up the market. But so the thing I don't like is if they go private at Fannie Freddie, the lender of last resort is the Fed, and we're literally begging on CAMP, California MBA, the Mortgage Banker Association, NAM, AIM, all these organizations. We're begging on them to influence the Fed and Treasury to lobby on our behalf, and we're so this isn't going to be our last recession. This isn't going to be our last pandemic. I don't care what anybody says. We've been facing them, often. This is going to be our last set of social unrest. The gap between the haves and have-not is widening. We are in an, we're going to need a lender of last resort. And so, I appreciate the mission that FHFA has to privatize and recapitalize Fannie and Freddie, but where are they saying who the lender of the last resort is and what the playbook's going to be going forward when they are recapped and released? I don't see that anywhere. It'd be nice if they would communicate that, but they don't seem to want to say this is what we will do, because all we want is certainty, right? That's it. That's what we all want.
Right.
So we want to continue to go about our lives and do our job.
Right. The concern though is if someplace like, any private company is up against a big bank, they can go to the cash window once Fannie and Freddie are privatized, but nobody else can. So it's really going to change the dynamics of the whole industry, won't it?
Well, yes. I mean, remember when banks go to the cash window, they have to borrow against an asset they currently have. Now, of course, if the rate is 10 basis points, it's pretty cheap. And to turn around, even a 2.25%, 5-1 ARM, they're still making money on a massive level, assuming, the asset behind it is good. So, yeah, I mean, they have a huge advantage being a bank. I mean, there's talk about letting independent mortgage bankers with the proper balance sheet, the proper financials, to be able to borrow in the federal home loan banking system, which is, that would be great. That would be a great solution.
Who are we talking about, though? We only talking about the big ones like Quicken and.
Well, I don't, it'd be nice for any IMB of any size that meets the proper financials. So, whether I show my financials to the federal home loan banking system, or a warehouse lender that we use, or our broker dealer, or an aggregator, or a regulator, or a state. I mean, we have to have 30% of our total net worth in cash at all times, minimum, period, end of story. That's it. So, if we have $100 million net worth, we have to have $30 million in cash at all times. That's with payroll, with a $10 million payroll that we pay every 2 weeks out there, with, $30-40 million in margin calls out there, with our servicing portfolio that's out there. I mean, it doesn't matter what it is. We have to have that total net worth and that certain cash requirement. So if I meet a set requirement, then, what does it matter what size we are and who we are? I would say no. I think, I would argue, our company is better capitalized than most regional credit unions. There's a lot, and it's a reason why they don't do mortgage, because, they're smaller, they serve smaller communities. And so, look, I don't know where the line is drawn, but I know it certainly is skewed towards banks right now. And up to this point, FHFA and Fannie Freddie have been a saving grace for independent mortgage bankers. But what's really has been Ginnie Mae. I know that they're in the news a lot for not approving as many new independent mortgage bankers, but they already have a lot of non-banks that are Ginnie Mae issuers. And they were the first ones to come out with the PTAP and say, look, here's liquidity if you need it. If you need to borrow funds, we'll lend it to you at 6% or 5.75%. They're public about who borrows. They're public about the rate. And they came out very swiftly and very quickly and provided liquidity to the marketplace for non-banks. Now, we didn't take any. We didn't need any. We're serial savers. We're a good risk. But I got to tell you, it would have been nice if FHFA, did that, but they didn't, And so look, there's just a lot of competing forces out there in providing liquidity to the marketplace, which in the end of the day translates to what we see in our rate sheets, what we see as far as product mix, and what we see as far as guidelines in pricing. And it's changing quite a bit, but what I see right now is it's all trending in the positive direction for originators.
Yeah, no, I was joking this all the time. It's like, hey, we're now past 3 weeks of just good news in the mortgage world. At first it was bad news, worse news. Everything was getting worse, starting middle of March. And then about 3 weeks ago, it started turning, and suddenly we stopped getting the devastating news of lenders being, the last part we got was the equity line lenders stopped doing refinance lines. And that was 3 weeks ago now. And now it's, the rates seem to be getting just that little bit better, and programs are starting to roll back in. We're starting to get non-QM back in again. I wouldn't be surprised to see, maybe some more jumbo lenders start to lower their rates as they feel more secure. So all of it seems to be rolling in the right direction. And
yeah, jumbo. You bring up jumbo, which is, he who has the gold makes the rules. That's it. And
right.
And it's a balance sheet play. It's purely a balance sheet play. You do $1 million loan, the bank has a problem, and that's the old adage in the industry. It's never changed. You have a $100,000 loan, you have a problem. You have $1 million loan, the bank has a problem. It's $1 million in their cash. They're paying for that house, and it just sits there on their balance sheet until they can pool them all together and sell a non-agency securitization. And right now, the securitization for the market for non-agencies is not great. It's not non-QM borrowers are 20 times more likely to request forbearance than a Fannie Freddie borrower. Now, their overall rate of all the private label loans going to forbearance is about 9%. So it's not that bad. At the end of the day, the data, but this was supposed to be the year of non-QM, but we're going to do 35 billion or 40 billion maybe in non-QM loans for the year, and that market evaporated. And then jumbo is the next asset that's completely balance sheet driven, and so it's a lot of money. $1 million, you're like, oh man, this borrower's good for it. Like, why didn't the bank just send him it's $1 million. It's $1 million. Like, it's a lot of money, you know? Like, what if that borrower just says, I'm savvy, I run a business, I'm self-employed, I know how to run a balance sheet. I get a 12-month free lunch on forbearance. I'm taking that. No questions asked. What? All I got to do is just reinstate it when I'm out of forbearance and or just make 3 payments and I can go right into a refinance. Oh, I'm totally taking that. So now you got someone that lent $1 million and now they got to front the payment. FHFA isn't making payments 5 through 12 for jumbo loans. If you're a lender and you lend $1 million, that borrower goes into forbearance the next day, that lender pays the taxes, the insurance, the principal, the interest on $1 million for 12 months. And then that borrower could say, hey, you know, I can kind of get used to not making this payment. Yeah, I'll just go into foreclosure. And in California, they got this law that's going to pass where 5-year moratorium for foreclosure. If you go into forbearance, obviously that hasn't passed yet. But could you imagine the exposure?
For my dead body, Kevin.
Working against that one.
Oh yeah, I mean, we put out last week. We measured about 450 people signed the petition that we put out at PRMG through Laura Roush and Paul Lucido from our VP of product development and our CMO. You know, we're pushing it too. We're getting that petition signed. But I mean, look, I just moved to the state 4 years ago. It's crazy the sentiment of how to do business in this state. I get it. You want to help consumers, but I'm telling you, like, what's crazy, the irony here is the FHFA may step in if this law gets close to being passed or gets passed, and Mark Calabria might have a conversation with Governor Newsom and say, you know, we're not going to buy loans in the state of California if you pass this law. I just want to let you know that. So, I mean, that's literally what the talk is about that law. I mean, it's
we're
like
having those conversations, Kevin, as I know NBA is too. So we are, I mean, shouting from the rooftops that you cannot do that and think that we are going to have a sustainable mortgage market. So again, that is why when you see a call to action, when you have somebody ask you to join your association, please, for God's sake, do it. It's critically important, especially as we go forward, even as we come out of this crisis where we have just sort of been in the trenches and in survival, you know, like figure out how to survive next mode for the last couple months. Now that we're coming out of that, we really need to not bury our heads back in the sand and think that everything's fine, because what's happening on the back end is there are a lot of associations that are representing people who have no understanding whatsoever of how the market works, how it translates into what we do every day, and how it impacts even a tenant's ability to have a place to live. So if you make laws so that lenders can't afford to lend here, landlords can't afford to do business here, it's going to impact them, but they don't understand that. So we are definitely all over it, as I know that, again, NBA, NAM, and mortgage bankers, California mortgage bankers. So stay engaged, stay engaged, stay engaged. It's critically important. So we're going to wrap up in a few minutes, and I wanted to just throw something out there because we did get somebody asking whether there was a way to delay property taxes without penalty. I believe the answer is no. Do you know anything different than that, Kevin?
delay property taxes without penalty. I have
right.
not.
So you can have a forbearance on your loan, but let's say you don't have an impound account. Can you delay your property taxes?
I have not. I
haven't either.
I've seen some counties they'll push you back until I think it's June, which is coming up now.
Yeah.
I have not seen the government holding up their hand saying, you know what, don't pay us. I've heard them tell everyone that they cannot pay everyone else, but I have not heard them say don't pay us.
Interesting statistic out of San Francisco this morning. I was listening to the news and they were saying that it was either 95 or 97% of all renters are paying their rent on time in San Francisco, despite all of this. Now some of them are, struggling and tapping credit cards enough to make it work, but they're still making their payments. So, and then they pass these laws that, hey, the landlords can't foreclose or evict. But it's like, those are the people that are not paying their rent are the exception, not the rule. And they're making the rules that hurt the whole. They don't get that.
Yeah,
I have a client who go ahead. Sorry, Kevin.
Well, I was just going to say, from a servicing standpoint, the lenders have to front the taxes and insurance. So no one's paying that on behalf. So what's an interesting question we're trying to get clarification on is if a borrower goes into forbearance and then they want to do a refinance when they reinstate, if they weren't paying the taxes and insurance, but they make, let's say they miss 4 payments and they make and they have their escrow as a part of it, they only partial pay the principal and interest, can they roll the missed tax and insurance into the payoff to do the refinance? We're actually trying to get clarification on that. We think the answer is no, because that would be considered not reinstatement. Now, if they have waived escrows and the borrower is paying their own tax and insurance and they come due in November and a borrower is still in forbearance and they want to come out of forbearance, my understanding is that the reinstatement plan, if they don't pay everything all in one lump sum, the loss mitigation plan, the deferral payment can include the tax and insurance to be thrown at the end of the 360-month payment if taxes and insurance are due at that time. So for example, if someone comes out of forbearance in August or September and taxes aren't due, we are hearing that the only part that could be thrown in the big balloon deferred option down to the end is just the principal and interest that was missed. So we're trying to get clarification on that. I mean, we haven't had anybody come out of forbearance, so we don't even know how to handle it. So there's still some uncertainty there, and we're trying to get clarification. I actually have, I think I have an MBA call tomorrow. I think it's tomorrow. So that was something they were going to hunt down and chase down for us. Gary Malice, who's he's our 4th partner. He's brilliant. He's our chief strategy and capital markets officer. He's all over that. I mean, he's like all the stuff like that. He's just really drilling down. Super smart guy. He's trying to hunt down some answers for us too.
I saw him being interviewed. He was super smart, and so we'll hit you up for the answer to that. So once you have it, try to remember us. So with that, we're going to wrap up for today and just remind everyone to register for tomorrow's credit and COVID webinar. It'll be very informative. We're really looking forward to it. And then Thursday, social hour mastermind brainstorming session, and then look forward to next Tuesday with Rob Chrisman at 11 on Tuesday. So Kevin, thank you so much for being such a light of information and being so willing to share with everyone. And it's you have a different approach, and I love it because it's so broad and interesting. So thank you a million times. Thank you.
Those of you who don't follow Kevin on LinkedIn, I highly recommend him. He's really got some great market updates almost on a daily basis. Sometimes at 3 o'clock in the morning.
Yeah, I know, he doesn't sleep, but whatever. Yeah.
Well, you know what?
You can sleep later.
That's right. I always say I'll sleep when I'm dead, and I appreciate you watching my content. I think it's really important what CAMP does. You know, it matters. It matters to have a voice at the state level. This is one of the largest state organizations out there. You know, I mean, California, Texas, and Florida. You know, New Jersey is another great one. You know, PA. There's a few of them that come to mind. Arizona's good. You know, they just really lobby on behalf of all originators at the state level, and that matters. I mean, it does. Think of this moratorium passes. I mean, we're screwed. I mean, if this thing passed, I mean, the pricing for loans with the California hit will be like 3 points, you know, permanently. You know,
oh my God.
I know something like that. I know.
We're working with CAR, California Association of Realtors too, and I'm really seeing a willingness for the associations to work together more, which makes the most sense in the world to me. And so that is what we're going for, is collaboration as an industry, no divisiveness. It doesn't help anything. And with that, we're going to say goodbye. It is, and we will look forward to seeing you tomorrow. So thank you.
Thank you, Kevin.
Thank you, Kevin.
Thank you. Have a great day.
All right, bye-bye.